Okay, we're going to work some exercises from the Phillips 7e textbook for chapter 5. And this one's relating to cash and internal controls. So we'll start with some mini exercises. And this one is in your textbook on page 236. I have the ebook up, but as usual, I'm recommending that you use the physical copy because there's a lot of resources there that you can just flip back to help you with your assignments. But I just need something to display, so that's why I'm using ebook. So this exercise is the mini exercise 5.2, and it says Fox Erasing has a system of internal control with the following procedures. They want you to match the procedure with the corresponding internal control principle. And so the first one is the treasurer signs the check. And so that is an example. I'm sorry, I'm just going to go ahead and reveal these since they're just listed as A, B, C, D, and then we'll talk through them. Didn't get that one highlighted. Let's try that again. The first one is A, so they're almost in order, A, B, C, D. Establishing responsibility. When the treasurer is the one who gets signed the checks, that means we know what caused the problem if a problem arose. And then the second one, the treasurer is not allowed to make bank deposit. That's an example of segregation of duties, where you have one person that records the cash and another person that handles the cash. So it's better to separate those tasks so that the same person couldn't just note that an error and then take the cash at the same time. So a person that's doing the record keeping should not be the same people that are handling the cash or receiving the cash. Okay, and then the third one, the company's checks are pre-numbered. That's an example of documenting the procedures, because that way you can track if there's some checks missing. And then the next one, used checks are stored in a vault. That is an example of restricting access. And then the bank reconciliation prepared each month is usually done by an outsider, independent verification. So that's E. So let me give you a minute and let you see what you can do with the next one, which is the same sort of thing, almost the same problem. It is mini exercise 5.6. And it's just pretty close to that one. It's over on page 240. Take a second and mark A, B, C, D, E, whatever you think they are. You can pause the video while you do that, and then I'll just go ahead and solve it. Okay, the first one. The business manager has the only key to the check signing equipment. That's an example of restricting the access. Then the purchasing manager orders all goods and services for the business. That is establishing a responsibility, so that you just couldn't have some random people making orders and maybe not even ordering things that are for the business. And then the bank reconciliation prepared monthly. That's independent verification. Then pre-numbered checks used for all payments. That's an example of documenting procedures. And then the last one, the company asks suppliers to deliver the merchandise to the warehouse, but mail the invoices to the accounting department. And that is an example of segregating the duties. So one person delivers the goods that we order. Some people deliver, not some people. The delivery is separate from the invoicing, so that whenever the company tracks what deliveries were accepted, they can match those to the invoices that they received. Okay, and here's another, this one relates to bank statements. M5.8, just a little further down there. This one is talking about how to organize the bank statements. And then we're going to actually do a bank statement reconciliation. Indicate whether the following items would be added with a plus or subtracted with a minus from the company's books or the bank statement side of the bank reconciliation. So when you do a bank reconciliation, you're doing a two-step process. As you know, in the lecture that we talked about, the examples there, we had discuss the fact that the banks, you reconcile the bank statement in 2 stages. You look at what the bank says the balance are and then make adjustments that for things that the bank didn't know about that the company had on their records. And then you look at the company's records and adjust for things that the bank knew about that the company records did not reflect yet. So all these things together bring you to the same conclusion for taking the bank balance and adjusting it that you get when you take the company balance and adjust it to correct. So we're looking for the correct balance, and usually the bank's not exactly right and the books are not exactly right for a bank reconciliation because there's adjustments to be made on both counts. So the first one, outstanding checks. I'm just going to reveal them and then we'll talk through them. Outstanding checks of $12,000. That is a reduction on the bank side because the bank does not know about anything except what has cleared the bank. So if you look at the balance the bank says you have in your account, it's inaccurate if there are some checks still outstanding. And the book side knows about all the checks that have been written, so we know which ones are outstanding, meaning they haven't cleared the bank yet. And then the next one, bank service charges of $15. That is something the bank knows about, but the company books probably have not recorded until they get the bank statement. So company books have to show a reduction in the balance that they have recorded because they haven't usually recorded the bank service charge until they see that statement. Then the next one, the deposits in transit are $2,300. That is deposits that the company knows about, but the bank has no record of yet because they haven't actually cleared the bank. So that's add back for the bank's balance. And then the interest earned at the bank is $5. So that is something the bank knows about, but the company records do not reflect. So we need to increase the company records balance by that amount. Okay, so that's just some general guidance about them. And then we're going to implement that with this problem PB52 that we're going to do. It's like your homework. Go to the B section. Doesn't want to go there. Let's try again. There we go. PB52. So this is page 251. They start with 5.1 and this is 5.2. Okay, so here's what we got. The bookkeeper of Tony Company has asked you to prepare a bank reconciliation as of February 29. The February bank statement and the February T accounts are provided here. So we got the bank statement. It shows all the different activity that happened. It shows deposit. It shows first checks, and then the next column is deposits, and then other transactions. One was an NSF check. In other words, a check we deposited that bounced back it was not good. The customer didn't have money for it. And then an interest earned that the bank is giving us at the end of the month, and then the service charge the bank is charging us at the end of the month. So all these things will be used to reconcile the bank, the book side and the bank side. So we'll be able to tell from this what checks are outstanding because we can see the checks that have cleared. Then when we look at the T account, we'll know what checks were written. So we'll know if they all cleared or not. Same thing on the deposits. We'll look at the deposits that cleared the bank, and then we'll compare that to the deposits that are recorded in the books, and the ones that are still outstanding, we'll have to adjust the bank side of the reconciliation. Then these other transactions are all adjustments that need to be made to the book side because those are things the bank knows about that they have not notified us of probably possibly until we get the bank statement. So all the things in the other column are going to be adjustments needed that we have to record in our books. So let's go ahead and look at the T account right quick. The T account is just showing the balance at the beginning of the month plus all deposits as debits. And then the credits is showing all the checks that were written, not all cleared. So it shows us an ending balance for the bank of $30,640. That's where we'll start. Let me see if I can get us some black ink on here. Beginning balance for the bank was this $30,640. The beginning balance for the book was the ending balance of the T account, which was $37,450. So I just pulled from the data set, I pulled the bank balance. I want to highlight it. And I pulled the book balance. Okay. So that's where these two numbers came from. Make this just a tiny bit bigger if I can see it better for us. Okay, so we start with that. Then we have to compare the two to see which, on the bank side, we always take the bank, what the bank has, and we add deposits in transit, we subtract outstanding checks. Usually that's all we do. The only other thing we would do is if the bank had made an error and we're going to need to contact them to correct it. Like if they let a check clear for the wrong amount, or they made a deposit and had keyed in the wrong number. That does happen in real life, but it may or may not on a regular basis happen. Usually there's not an error in the bank, but there could be. Okay. So what we're going to do is we're going to look at the different checks to see which ones clear. See the checks on the bank statement? The checks that cleared were 101, 102, 103, 104, 105. So 101 through 105 cleared. When you look at the banks at the T account, you see that we wrote checks 101 through 106, but the only ones that cleared were checks 101 through 105. So if you compare them, no, don't do that. We're going to get all these first five, I'm just highlighting all that. Those cleared, but this one, the $1,200 one, did not clear. Okay, just give me a little bit of highlight. That's fine. A $1,200 check is still outstanding. All right, now let's look at our deposits. The deposits were $7,950 and $14,150 according to the bank. 3 deposits. In our T account, you see we have deposits of $7,950, $1,050, $14,150, and we have an extra deposit that the bank didn't mention because they don't know about it, for $7,800. So there's a deposit in transit the bank hasn't seen yet for $7,800. We're going to add that to the bank's, to the balance the bank thinks we have. And then we're going to reduce for the outstanding checks because the bank doesn't know anything about those either. So that's going to get us a corrected or an up-to-date cash balance, the bank's balance that they told us that we had, plus the deposit in transit, minus the outstanding check. That means that the corrected balance or up-to-date balance is actually $37,240. Now our T account says $37,450 is our balance. So we're going to need to make some adjustments to see why that is and see if we can come to the same exact balance for up-to-date balance on the bank side, I mean on the book side. We start on the book side and we say, now what adjustments do we need to make? We need to look at the bank statement again and see what's on there that we had not recorded yet. One thing we haven't recorded is this NSF check. That's a decrease in our balance. And then an interest income, we have not recorded that. That's going to be an addition. And then service charges, we have recorded, and that's a reduction. So the addition was just the service charge, the interest earned. And then the deductions were the NSF check and the service charge. So those things were not recorded on our book. So we're going to add them back to our book balance or subtract them from our book balance, whatever the case may be. $37,450 is what the T account says that our cash is. But since we didn't have these transactions recorded, when we record them, it's going to change that T account to correct. It's going to add 150 and it's going to subtract 40 and 320 to get us to our, eventually I'm going to touch the right thing. So it'll reveal the right thing. 37,240 is going to be our adjustment after we make these journal entries. So everything that you have to do to correct the book balance needs a journal entry because there's not another way, as you know, to get a correction on a T account other than making these entries. So we're going to make an entry for the interest earned. Now I want to tell you that some accounting teachers do not teach bank reconciliations because they feel that they are too simple. But my feeling is we should teach bank reconciliations because if you don't know how to do them, you're going to embarrass the people who taught you how to do accounting. And we don't want that, do we? We don't want you to have egg on your face either. Okay, so to record these things that we adjusted on the book side, we need an entry to record the interest earned, which is a debit to cash, a credit to interest revenue. That's what this first entry is. Then we need to record those deductions that we hadn't known about before. That means we need to, for the bank service charge, that's this one, number 3, we're going to debit bank service charges or bank fees or whatever you want to call it. And we're going to credit cash for the $40. For the NSF check, what is actually happening is we're going to go back to the customer and ask them for that money back because it didn't actually pay their balance. So what we did is increase the receivable that we have for that customer by $320. So we debit accounts receivable and credit cash for a return check. Okay. These entries are necessary because the bank has appropriately recorded these charges, but Tony's company has not recorded them. Yeah, we knew that. The balance that's going to be reported on the balance sheet is going to be this ending cash balance after adjustment, $37,240, which is the same number we would have come to for up-to-date balance on both sides of the reconciliation. The last thing is the balance sheet. What is it going to show for current assets? And in the description, they tell you that they have petty cash of $50. So in addition to this cash account balance, that's the checking account, they have $50 worth of cash dollar bills in their petty cash fund. So they add that to the cash number to come to $37,290. All right. And that's all the 7E exercises for this time.